So thanks for joining us today for the first half FY24 financial results. Before I pass to Gary, if you do have any questions, just put them in the chat box, and we'll make some time to get to them at the end. So I'll leave it with you now, Gary.
Very good. I'm not on mute, is that right?
Correct.
Very good. So thank you. It's quite funny every time we do this, we have these issues, but hopefully this is the end of that. I'd like to thank all of you. We've got a good number of people here today, which is terrific considering the showing interest in the company and what we're looking to do. The results, I think, have a mix of very, very good and challenging, and I'm not going to run away from any of that, and I'm going to look to talk about where we commenced back in 2021 when I took over the helm in this particular role, and get back to talking about the tortoise rather than the hare approach. And the numbers that we're reporting today have elements of both in that. But my position is that we are in a very, very good position along the trajectory that we look to build for this company at that particular time. And I'm really excited about the future, albeit the half-year numbers in respect to operating EBITDA are a little bit below where I had hoped them to be, but there's actually very valid reasons for that. And it's to do with that tortoise versus hare approach, where we're investing in the businesses that maybe aren't performing as well as they can, knowing that they can. And I think that's the really important point. I don't want to be assessed by the market on a short-term basis. This is a long-term play. And I think I'd like to particularly thank those shareholders that have been with us since 2021 and have been very, very supportive in that journey, because I think we're on the right journey, and I think we're now in a position to have enough capital and not necessarily use our shares to make further acquisitions and grow this strategy, which is a terrific strategy, and one I think that will see the company grow and prosper and become one of the premier financial services distribution businesses in the country. I might just touch on the numbers firstly. We might go to the disclaimer before I do that so I don't get in any trouble. None of the information I'm giving today is personal advice of any nature. It's all general, and that's what Sequoia does. I've talked about this before. Only 16% of Australians get personal advice, which is a real tragedy. There's not enough advisors giving advice. There's more need than there is advisors, and part of our numbers today talk to that. And as I'll touch on later, but the licensee services business has been the standout in this period and should continue to be the core part of our business and the core standout. And that's contrary to a lot of our competition. So I think we're doing it right. We're growing and we're increasing our profit and our percentage of EBITDA on revenue. So all those things are good. I'll move to the first slide. Thank you. So the financial highlights, basically that tortoise versus hare approach that I talked about. We've had 189% share price growth since we commenced this journey. So that's in some people's opinion not a tortoise, it's more of a hare. But over the last sort of 12 months, the share price has probably underperformed. And I think that's a consequence of really stepping back, tidying up some of the businesses so we can take the next large step of growth. And some of our numbers show that growth will come if we make these decisions. And I think that's important. The biggest number obviously is partly to do with the divestment of Morrisons. But I think I might just talk about that a little bit as well, because the Morrison business wasn't sort of something that we hadn't worked on. We talk about my ROAM numbers, and if you look at the current ROAM calculations and consider the Morrisons divestment, we are currently, as far as the balance sheet is concerned, the difference between the valuations of many of the parts that I value them at and that are seen in the balance sheet are stark. For example, the ROAM on the licensee services business is 40 million or moving to 42.5 million this year. On the balance sheet, it's about 7 million. So we are creating value within the business on an organic basis that doesn't necessarily come through the profit and loss. And I think that or licensee service businesses is very easily worth more than 40 million based on the run rate that's going to be above 15% on the roam in this financial year. In fact, it's going to, in my opinion, outperform that particular number. And in respect to roam, it's my own definition, so it's return on management equity. And what we're doing is telling shareholders what we think each division is worth, and then applying a 15% return on that valuation to justify that value. What I'm looking to do, it's all about compounding and tortoise approach. So what I'm looking to do is hopefully see that the equity valuation increase by 10% per annum, and then continue to achieve that 15%. So we're looking at compounding growth. This is a growth story. It's not an income story, in my opinion, even though, the 2-cent dividend we're paying in this period and the 4 cents dividend we paid in September suggests that we're an income stock. But what we're looking to do is looking to pay 80 to 90% of operating cash flow to shareholders after tax. And at present, with our share price where it is, it looks like we're an income story because I personally don't think the share price is reflecting correctly. The continued operations EBITDA was up 47.5% for the period to 3.2 million. It's actually, if you take out the non-recurring items and the costs of the divestment of Morrisons and many of the operational efficiencies that we improved, it is far closer to the 4 million. So I've been looking on some of the chat lines and it suggests we've missed our target. We have not missed our target. We're very confident the normalised business is completely on track to get towards that $8.5 to $10 million number. And, on a normal basis, that $10 million number is not something that we've moved away from. And I'll talk to that a little bit as I go through the presentation. We have continued to buy back shares. We'll be back in the market later today. We think the stock's cheap and we've got excess cash and we will be buying back stock. We stopped being aggressive on the buy because we had numbers coming out. We had been sitting there below the market, but we will definitely be looking to continue to buy shares in the market whilst they're trading at the current multiples. And really going back to that tortoise versus hare number, when we started, the stock was 20 cents a share. We had only 7.9 cents per share of net assets. And since that time, we've returned 10 cents per share in fully franked dividends from cash flows from the businesses that we've been operating and been able to generate what is now sitting in a bank account of more than $25 million. So our market cap was $25 million approximately. And now we're focused on moving forward. The share price, Andrew, we've had a question come in why we're so focused on the share price is because forever we don't want to be using cash to make acquisitions. We would like to use our paper when it's appropriate to buy businesses, but whilst we think it's at a price that's not satisfactory, we will use cash. And the cash flow statement that I think that shareholders should look at talks to that because we have used cash from cash flow to make acquisitions for people who wanted shares from our cash rather than issuing them. So we've bought shares for people selling their business that wanted shares rather than issuing them, and that does have some impact on the cash flow statement. I'll move to the next page. Touched on it already. The special dividend of 4 cents per share was paid in this half, and we're now paying a 2.2 cent share for the half year. We are looking to maintain now, without specials, a consistent dividend stream of that 80 to 100% of operating cash flow. So we're being conservative in the first half. We want the first half dividend to be less than the second half where possible, which I think is consistent with sort of the mindset of Australians, where you get your interim dividend and you're hoping the second half dividend at the final year is slightly bigger. That's what we're hoping for. The numbers that we're projecting, 4 million in the first half, 6 million in the second half, on a normalised basis is should talk to that. So we're focused on paying a minimum of 2 cents in the second half, so 4-cent dividend, fully franked. We've got plenty of franking credits, and we'll be buying shares back. So we bought 5 million shares back in the last 6 months for $2.6 million. We've paid out $7.5 million in dividends, and we're continuing to do that. The first half numbers that I talked about, which were probably not as great in the professional services business, and where we forecast, was because of 3 or 4 reasons. One is the Castle Corp acquisition. The second one is the ABS acquisition. We'd actually expected them to settle well before they did, and early in the half. The ABS acquisition's only settled in December, so there's no revenue whatsoever in the first half of the ABS acquisition. And on the Castle Corp acquisition, there's only really 3 to 4 months of real revenue in this half, and we incurred a lot of staff expenses, closing office expenses, buying some shares expenses, and changing over some computer systems in the normalised accounts. And none of that are being put below the line. Everything we do, we just put in normal expenses, and where other companies sort of spin them out a little bit to show a more normalised result. But really, we're looking to have our EBITDA and our cash flow from operations 1 for 1 where we can, and that's probably a strategy that my conservative nature prefers, because I like, when I read other companies' balance sheets, profit and losses, for them to be clean, and that's what we're looking to do. We also paid our ANZ loan down by $1.75 million, and we after all of that, all those acquisitions, all that buyback, all the dividends, etc., we've still got $23 million of cash, and generating about $1 million a month of cash in the business. Next slide. The operational highlights. I think the operational highlight is twofold. The 2 businesses that I think are standouts, not necessarily reflected in the numbers just yet, are the licensee service and the professional services. Licensee services business has grown dramatically in respect to revenue. We are winning. There's been a lot of movement in the industry from groups like Insignia, AMP, Diverger, Centrepoint, WTL, and a lot of advisors are looking for homes and looking for new licenses. Sequoia and Interprac have been the real tortoise in the industry. We've been very, very stable. The market respects our licenses very much. We're getting inbound inquiry from advisors on a regular basis, and we were the number 1 license in the country in respect to net growth across the industry. Most licensees actually had a deterioration in overall numbers. We were plus 33, and of the 3,000 odd licenses, Sequoia, being a larger license, remarkably was the highest growing license in the country in 2023. So that's no acquisitions. That's pure organic growth, where the market is coming to us and seeing our value proposition, and that's reflected in our numbers. The revenue and the profit and licensee services this half has reflected that sure but steady approach, and we're really well placed now for that business to continue its scale up and get a return for shareholders, but provide value for the underlying advisor, who is actually experiencing extensive growth in their own practices in their own right. The demand for advice is increasing, and there are a number of advisors out there providing advice solutions is decreasing. So they're busy, and that's reflected in our numbers. If you look at the average revenue per advisor in our group, you can see by the fact that we've only gone up around 10% advisors, yet we've had a 60% growth rate in our revenue, shows that. And that's going to continue. We are already in this half experiencing strong interest in joining the licence. We've had several advisors join the licence in January. There's a weekly report that comes out. Sequoia's been named on that almost every week since since those have been reporting. So that's really good. The second highlight, I think, is the professional services division. So this is a bit of a cottage industry where we've been buying lots of businesses. Originally we had the NCAA corporate business. We created Doc Centre. We bought Castle Corp. We bought Panther Corp. We bought a number of these small businesses, and it takes a significant investment in technology to bring all these small cottage businesses together. And the half-year numbers, in respect to revenue, look terrific, but in respect to EBITDA that came out of those businesses doesn't look as terrific. But I'm convinced that we've got it right, and the investment that we have made in technology and people and improving our offering will show the tortoise rather than hare approach. And we've just had to take a little step back in respect to EBITDA and return on revenue in respect to that particular business in this half. But we are really well placed to see that particular business achieve a $3 million EBITDA in full year 24. So the number in the first half was just over 1. So we're expecting a very, very strong second half in that particular business. And that includes all of the revenue coming through from 6 months of Castle Corp, where we only got 3 or 4, and 6 months of ABS, where we got none. Yet we had costs in this half's expenses for those businesses. So that is good. The investment in the direct division was necessary. We acquired a business that we had expected to deliver far more than it has. I think people would be aware that we've taken action in the courts to address some of that. But irrespective of that, we're looking to invest in this particular business in a manner that we get the type of return that we would expect on the roam of 15%. We've cut expenses dramatically in this particular business. We've gone from a headcount of around 13 to around 6. The business has had a little bit of a refocus in respect to the type of services it provides. We've been providing an awful lot of services for no return, and that's a challenge. Obviously, we've been providing services that the market loves, but not necessarily generating an income stream for doing that. And we just can't do that. What we're here about is generating that 15% return. We're addressing it, and we're moving in a couple of new directions, which are already looking good. The results in December, January and part of February reflect that business has turned, which is particularly good. In December, the business generated more than the 6 months target, more profit than it did for the first 5 months. So it's turning, which is good. And the equity markets division, we're opening up new channels. We used to rely wholly on our own internal distribution for taking product to market in that area, but we're now looking at a lot of other groups to take that product to market. So they're the highlights. I think that's all the positives. We'll move to our next slide. I might not cover this one too much. It just talks to the normalised EBITDA of where we're looking to get to 10 across the businesses. So I think the most significant parts of that is the tailwinds for licensee services, equity market division and professional services should be very, very strong in the second half. January and February have been very good, giving us confidence. The reason why we've gone to this 8.1 to 10 is because we did table 3.1, and half of 10 is 5, so we've added 5 to get you 8.1. But we do expect 4 and 6. So we're my budgets and my expectation is that we're aiming for 10. But it'd be somewhere between 8.1 and 10. You can bank that. That's the most important thing from my perspective. Next slide. Many businesses, one company. This slide hasn't actually been updated yet with the ABS and Castle Corp in the professional services. The licensee services business in particular, Enterprac was the standout. Corporate finance had a slow first half, but we're expecting the second half to be very, very strong. family office continues to do exceptionally well. The funds under management in that business have increased another $50 million in the 6 months. So that's a really good steady income and doing really well. It's opening up into many Asian markets, and a lot of there appears to be more immigration again, and a lot of families with high net worth in the Asian community are coming back into Australia. So that's a very strong market for that particular business of ours. The insurance broking business is steady, and the wealth management business, where the brokers, we've reviewed that. So broking income, I think anyone on the call would realise, has been challenged with equity market volumes down and brokers doing it tough. We've done a restructure there, and those numbers are beginning to improve for us, and we're actively looking for new brokers into our business. We have a very friendly 70-30 grid that we provide to that particular market, whereas a lot of brokers are on a 50-50 grid. So we're offering that out. The scale that we have for all the other businesses allow us to be particularly competitive in that space for brokers, and we're looking to grow the broking business in Melbourne by another half a dozen, and in Sydney by another half a dozen, and that will add value to our corporate business, our family office business, and the overall offering we provide to wholesale clients through our direct business. So that's a real focus in the next 6 months. Next slide. I've touched on it before. The 15%. So I mentioned that SWM, Sequoia Wealth Management, we're increasing the valuation, our internal valuation in this business, sitting on our balance sheet at around 7 million. But we believe that the licensee services business, if we were to sell, merge, or whatever, the offer would need to be well over 42.5 million. This is a business that's easily generating 15% return on that. It's got lots of growth aspirations, and it adds a lot of value to the other parts of the business. So I'm very confident in that. We have a mix of the licensee business, where we license approximately 400 advisors, and they get a split, a tight split, and you take on all the risk and you provide all the services, but they own the income. We also have 100% owned entities. And one of the things that we're definitely going to increase over the next 12 to 18 months is to continue to buy retiring advisors' books and bring those into the 100% owned equity entities, such as Interprac Securities and Sequoia Family Office. So that's an important transition we're making. Groups like Fiducian and some of the other groups, they own their advisors. Licensees like Centrepoint, ourselves, Count, etc., tend not to, but there's a move where licensees recognise the profits actually in doing the business rather than just licensing it at a much higher margin. We're aware of that. We've got cash to do it. Most advisors don't want equity. They want cash. We're in a position where we can give them cash, and we'll definitely be making acquisitions in that space. Next one. Professional services. Revenue was up 10% from last year, which is reasonable, but it was up much higher than that because we're reporting in a different manner now. We're not counting the ASIC fees. So when you set up a company, trust or super fund, there's the setup fees, which we charge around $150 plus an ASIC fee. In the trust and super fund, there's no ASIC fee normally, but in a company, there's an ASIC fee of about $600. So you charge $750, and $600 of that is actually ASIC fees. We're not reporting on the ASIC fees straight through now. So if you rolled that back, you would see our revenues actually up much more than the 10% we're showing this year. The integration costs have been at least $300,000 in this division. That's not counting for any IT spend, which is, we had 6 full-time IT staff working on the integration and the professional services business over the last 6 months. That's a very significant spend. That's just in normalised expenses. Some of that has ended, but definitely the overall expense line will come down in this division, and the revenue will go up with the ABS and Castle Court revenue coming through. So we're expecting a very, very strong second half in this particular business. But more importantly, very long term, we're expecting very strong growth in the business. The valuation we've currently put on this business from our Rome perspective is $20 million, and 15% return is $3 million. We expect that to grow, the Rome to grow by 10% per annum and continue to provide 15%. So this business is core. The reason why it's important is because it's accountants and financial planners that use this particular business. It allows the licensee services business, the direct business, and all of our other businesses to interact with approximately 3,000 accountants that we do business with. We're also increasing our emphasis on the self-managed super fund administration, providing those services in an outsourced capacity to that database. We haven't been as successful as we would have liked, but we're upping the ante on that, and we do expect in the future to see our SMS administration have a much more meaningful impact into that particular division. But very confident with the $20 million, $3 million return on that particular business. Next slide. Equity markets is, if you go through the accounts, they look unusual because Morrisons used to be in this number, and Morrisons was a high revenue, profitable business. We continue to own 20% of Morrisons. We sold 80%, as I think everyone would know, with the cash in it for $40 million. The cash in Morrisons is currently around $15 million, and that business generated about $1 million return for the half year. Didn't pay a dividend, so it's not necessarily reflected in the numbers, but that business continues to do pretty well. We own 20% of that. We're happy shareholders at present. The relationship with New Quantum's continuing to improve on a daily basis, and they're investing a lot in that particular business to make it a more meaningful player than we could have. And the capital that we got from disposing of that asset when it was above my Rome number, it has placed us in a really good position longer term. But what it has done is distorted the longer term picture of that $300 million revenue that I talked about several years back about aiming towards. And it takes out a very, very big chunk of that number, and has put us in a position where we're pushing out that $300 million revenue to 26, 27, opposed to if Morrisons had been in there at 24, 25. So we still believe without Morrisons we'll get to $300 million at an 8% return by 26, 27, and that's the tortoise versus hare approach. But we have taken a step back in respect to total revenue because of the significant contribution that Morrisons made to that. Also in equity markets, the Sequoia specialist investments that we offer in 21-22, we definitely made a decision to reduce the number of offerings that we took to market, and that's had an impact of reducing the profitability in that business. But since August, the train's going past, so I hope you enjoy the train there. So since August, we've upped the ante on offerings. We've got third-party distribution now looking for us to create product for their distribution networks, and I'm confident that this particular business can get towards $2 million EBITDA. No Morrisons, $2 million EBITDA in its own right on a long-term basis from 24-25, but have a very strong second half and begin to see that in the numbers. The last one is the direct investment, a major restructure. I put my hand up. We made an error in acquiring the particular business that we acquired for the price that we paid. It was not what we had led to believe it was. There is court action taking place. We have tried to settle on a number of occasions, but unsuccessfully. So we're going to court. That said, there is an absolute place for the direct investment arm. We're really going back to where we were before with a few little positives. We've sold the yield report business. We are changing the informed investor business. We've really stripped the number of staff out, and we're no longer providing this as a free service, and trying to live on marketing hours. And that's very important. The Corporate Connect business has had a restructure in how we pay our analysts, and the Share Cafe and Financial News business is also tilting to new forms of revenue to really capture the investor relations type market and the corporate video type market. We've got a terrific studio in Sydney. We've got really good journalists. We've got terrific intellectual property in Paul Sanger, in particular, heading that business. So it's been a major disappointment. I've got more grey hairs than I used to. However, I have a lot of confidence in this business now that Paul has taken the reins and brought a new energy to this particular business. I'm confident that we can get towards $500,000 profit in this year. And, I think that's an important change from when it was losing money. And I really don't want to talk too much more about the court, but we're going to court for a significant amount of money that we feel shareholders have suffered for in respect to that. Next. Earnings guidance. The valuations, I think, the sum of parts is the critical thing for me. So I'm really confident on those numbers. There's been an upgrade in respect to licensee services and a downgrade in respect to equity markets and direct. But the subtitle sum of parts, in my opinion, $78 million at 15% return. I expect $11.7 million EBITDA from the underlying businesses. You take out head office costs, which could be lower because we've got interest in there, and EBITDA is $10 million. So that's where I'm pushing for. Some of the we've put out there $8.1 to $10 million, but in respect to valuations, that's my expectation on every single owner of those divisions, and that's where we're pushing for in full year 24. And as I said before, we're looking for an increase of towards 10% in those valuations per annum, and a 15% return on those businesses per annum. EBITDA $10 million, pay $3 million tax, $7 million, and then pay 80% of that out as dividends. That's the goal. Pretty simple. Lots of businesses, all some mature, many immature. We're very early on the growth aspirations of this company. We're certainly far from a mature business, so I don't want shareholders thinking we're just purely an income play. We're absolutely a growth play, and I think that's reflected when you see the revenue number. Revenue is up, high double digits, very, very high double digits, and we're expecting really strong revenue growth and to get improved return on that revenue over time. So that's the goal. Next slide. So I think without trying to read from slides again, so the EBITDA margin of 8% on revenue is key to me. So that's $300 million long-term revenue at 8%. Revenue is key. We did improve revenue to EBITDA in this half, but we're still well below 8. And that's where we need to get to. Scale brings that. Efficiencies bring that. Investment in the past to create those efficiencies bring that. And that's where we're at now. We're definitely, we want to make acquisitions. I would prefer to be making acquisitions with, some shares rather than just cash. But we won't do it whilst our EV is where it's at. So we'll maintain our buyback strategy to attempt to allow us to close that gap. If as I said, we'll be back in the market if the stock's weak. I do remain, the Morrisons investment was an interesting, I hadn't intended to dispose of that business. We were, excited about that business, but we do remain open to divestment from time to time. But we need to get a premium. We've told the market what we think each business is worth, so those with interest may contact us. We have had contact on a couple of those businesses over the last 6 months, but the number was nowhere near a price that excited us enough to make a decision. And by that, I mean it needs to be a significant premium on what we think it's worth. So I think that's important. As far as growth is concerned, the number of advisors that we license has always been our long-term KPI. We want to get to 500 advisors that we license by 26, 27. We're at 350 to 400 at the moment, so steady growth, and the current growth numbers that we are achieving does see us get to that level. So you get a double whammy when you do that. Those 500 advisors reduce your overall expense per advisor. Those advisors use your other services. Those advisors are all experiencing, not all, but nearly all experiencing growth in their own right. And it allows our corporate advice business and our SMSF advice business and our documents business to all have more customer bases that they talk to. Move to the next slide. I think we might be finished. So we're on questions there. I didn't touch on Yuri. We made an investment. So we've got three or four investments that we hold. So we hold a 6% stake in Centrepoint Alliance that we acquired. We really like the Centrepoint Alliance business in respect to being able to work with them. There's a lot of services that we provide to financial planners that they don't necessarily provide. We're hoping at some stage we can work alongside them to provide their advisors some of the services that we provide that they don't, and also see if there's some synergy benefits in respect to sort of licensing services that each of us provide to each other. So it's an investment at this stage. We're not being aggressive, but we are in discussions with them about how we can work together for the betterment of their advisors and our advisors, and that's what it's all about from our perspective. We do have an investment in 20% of Morrison's. That business is going very well, sitting on our balance sheet at the price we disposed of it. So that's a good number. And we have a 20% in Yuri Funds Management, which is a business that's actually really performed well above the early expectations that we had. The business is actually now cash flow positive in less than 6 months. In less than 6 months, the February numbers I saw, there's $75 million of funds under management in a startup funds management business, and the performance of the three funds, Winston Sammett's Real Estate Investment Trust Fund, the Balance Fund and the Growth Fund, which are fund of funds, have all outperformed their quartile and outperformed the Morningstar like funds. So that business is doing really well, and we continue to be a happy shareholder there. Most important part of it, instead of just listening to me ramble on, is to take some questions. So thank you for listening to me, and I'll take some questions that have come through, and we've had some emails and also some online. So
we have. I might start with the share prices, a couple that might work together. So given the 2 cents interim dividend, should shareholders now expect regular dividend payments? And if so, what is the board's thinking on the balancing act between dividends, acquisitions and switching on the buyback, given your stated target payout ratio of 85 to 100% of net profit?
Yep, it's a good question. So we want to pay 80 to 85% of net profit after tax normalised as dividends. So in this half, we're suggesting the normalised profit's about 3.6 million. EBITDA less tax is about the dividend we've paid at 2 cents. We will continue to do that. We expect those numbers to grow. So we're looking, without being locked into that, I was talking about a 10% increase in Rome, which goes down to a 15% return on Rome. So we would hope that flows through to the dividend. So we would hope that the dividend grows at 10% per annum. Is my, if all those metrics line up, the compounding effect of increasing the equity and getting your 15% return on that should flow down to dividends if we keep the same payout ratio. So that's where we're looking to do. It's really important, in my opinion, to give people a reason to stay and put our shares in the drawer. So if they're getting fully franked dividend, the current dividend's sort of at 8 or 9% fully franked dividend, but if they're getting a 6 to 7% fully franked dividend by us underlying that strategy, I think that gives people comfort, as long as your share prices are continuing to grow. So that's where I'm coming from. In respect to the buyback, we're prepared to pay in cash for acquisitions 4 times EBITDA. If our enterprise value is less than 4 times EBITDA, we'll buy back our own shares. And that's the thinking behind that. Currently, our EV is below 4 times EBITDA, so we'd rather buy ourselves. We know ourselves, we know what we're doing, we're confident in what we're doing. So we're quite happy to, as we did in the last 6 months, invest $5 million in buyback when the price is at a price that we think is too low. But we do want to maintain cash because we do want to use some of it to give to shareholders, and we do want to use some of it to make further acquisitions. And we have identified some acquisitions that we would like to take the opportunity of continuing the due diligence and making decisions to acquire businesses that we see as opportune.
Great. I'll just touch on you again because we just finished off on that. Can you speak to the growth from 0 to 60 million FUM in such a short time?
Yeah. So, James Hird is an amazing person that I've met, and the market likes him, the financial planning community likes him. The amount of hours he works in that particular business is just astonishing. When I first met James, being a Collingwood supporter and him being an Essendon champion, I thought he was just one of those guys with lots of skill and ability, but his work ethic is unbelievable. And he's basically going around seeing financial planner after financial planner, doing presentations, talking about men's mental health to customer bases of financial planners, and the underlying investment strategy where he's picking funds of funds, and he's put together a terrific team headed by Alex Edmonds and Winston Samet. Winston Samet was Fund Manager of the Year for numerous years in the REIT space. So he's put together a really competent team. He's got Aitchison Consulting working with him in respect to helping out with the underlying asset allocation. And his performance is resonating really well with the financial planners. They don't want a fund manager that's taking huge risk. They want a fund manager that's selecting the highest quality funds at low management expense ratios and just generating steady returns. And the uptake within our licensee, but also with third-party licensees, and to get on platforms and get an SQM research rating in its early days of 3.75 and 4 talks to his work ethic, really. And I think he's just going to continue to be an emerging manager. And from our perspective, it's been a really good investment.
Great. So in regards to the licensing services division, it's outperformed again. How big do you see the opportunity, and will you consider bolt-on acquisitions to help accelerate that organic growth you've talked about?
Yep. So we will consider some bolt-on acquisitions in the Interprac Securities business, where we're acquiring customer books from financial planners within our network or financial planners within other networks. So typically the advisor would be someone who's looking to retire in 3 to 5 years, doesn't have a natural person to transition their business across to. We have staff and all the support services to allow that to occur, but bring them into that and then transition their customer book across to our employee advisors. So we'll definitely be looking to do many of those. You can acquire those on 3 to 4 times EBITDA, cash and some shares. So but the shares that we give those we'll buy out of the market if the price remains where it is. And our experience in that so far has been very positive. One of the guys who expected to retire in 2 years, 5 years ago, is still here and has no intention of retiring. And so it's a good model, and it's a much more profitable model. So the return on revenue is close to 35%, opposed to under licensee services at 6 or 7. So it's a much higher margin business, and the demand for the service is dramatic. So the community wants more advisors, whereas licensee services, encouraging one advisor to join our license opposed to another is a very competitive space. So definitely we'll be doing that. Professional services, definitely be making acquisitions there, and but it's very unlikely we'll buy another license. My experience is that buying another license, as many of our competitors appear to be doing, just opens up an opportunity for the competitors. So some of the licensees that have been acquired over the last period the underlying advisors didn't want to be acquired, and therefore they started looking around for new homes, and groups like us and a few others have been the beneficiaries of that. So groups like AMP, Viridian, etc., have seen a lot of advisors leave them because of that. So we're not going to play that game again.
If you're able, can you touch on the thought and the strategy behind investing in the competitor Centrepoint Alliance, and then in addition to that, and why is this a better use of capital than buying our own shares?
Well, Centrepoint's a really large licensee and a really well-run business. So Centrepoint's a little bit like Sequoia in some ways, in my opinion, in that 5 years ago they were really at a crossroad, and they'd acquired some businesses that maybe the market didn't perceive to be as good as they might be. The last two management teams, in my opinion, have done a terrific job. The board has been very supportive of the advice industry, particularly Simon Swanson, who's no longer there, but he was a terrific advocate for advice. John Shuttleworth is ex-BT. I think he runs a really good business, and I think he's recognised that the advisor is the key person that you need to support. We share that view, and Sequoia believes that there's no licensee that we can't do business with, and taking a strategic stake in that business is just my way of showing we're interested in working together with you. There's lots of services that we can provide Centrepoint to make it a better business, and likewise they've got some services that we think we might be able to use of theirs that could make us a better business. We don't have to buy Centrepoint in total, but we thought the stock was cheap. We think the management team is good. We think their proposition to market is positive, and from our perspective, we expect to get more than 15% return on that investment, and create synergies from other opportunities. So it was a positive acquisition from us. We also owned some shares in Diverge a while back, which we turned when the acquisition came in, and from time to time we've taken some small investments in other licensees where we thought there was an opportunity to work together.
I think we've got one more. So McKinsey in a recent report found that companies were more likely to outperform when they move beyond, but not too far beyond, their primary businesses. Given what you've spoken about and your acquisition strategy, can you say you would agree somewhat to that observation?
I think that's a generic statement that is probably true. I think our core business, being as the core business of Diverge, Centrepoint count, being licensee services, is a really tough business. So if you said, look, all I'm going to do is be the champion in that particular business, the marketplace doesn't allow you to make enough return on equity. So to win in that space, my opinion is you need to have multiple offerings, and you need to provide those advisors a whole suite of services and product that they can use for their underlying customer base, whilst they're paying you a share of their ticket in the licensing fee. So I disagree in licensing services. Some of our other businesses, like Morrison's, for example, I think that that's true. We couldn't provide enough of our capital towards that particular business to allow it to become a champion. You're competing with some very large players. Price was getting driven down, so you need to invest to get your long-term return, and we just didn't have the capital to do that. Professional services, we have invested for 10 years and we're at the top end. Licensee services, we've invested for 20 years and we're at the top end. The other two, well, maybe there's some argument there.
I think that's it. There hasn't been a question come through for a little while, so I think we might finish up there.
Right. No, thank you. I appreciate everyone being on board. Hopefully you've got some understanding of where we're thinking, and we can we can continue to be long-term owners of your capital in respect to the shares you invest in our company. And I wish you well. Please email me on my email or call my mobile if you have it, if you want personalised discussion. But thank you for your support, and we look forward to continuing to provide capital growth and return on our equity over the long term. Thank you.